I don't need to be a genius in what I do. That's the good thing about it. I am in a game. You don't really need brains. You need the right orientation.
Imagine you wake up one morning and instead of worrying about bills or juggling finances, you're calm, knowing that money is no longer a problem. You're living the life you've always wanted, and all these advantages are all thanks to one thing: dividends. Here's a crazy fact. In 2020, companies in the S&P 500 distributed over $58 billion each month to their shareholders in dividends. And if you look at the bigger picture, dividends have historically made up 42% of the stock market's overall returns. That's almost half of the market's growth, driven by a steady stream of payouts. So the next question should be, how can you use this powerful tool to build a stable income? Stay tuned, as we're about to uncover the breakthrough strategies to make it a reality. In this video, we'll explore some time-tested strategies, all inspired by Warren Buffett, the master of wealth building. Stick with us, and by the end, you'll know how to turn dividends into a reliable source of income, helping you secure your financial freedom. Let's get started with the video. Understanding dividends. To begin with, we need to understand what dividends are and why they're so important when it comes to reaching financial freedom. In simple terms, dividends are your way of earning money even when you're not working. Here's how it works. When you buy shares of a company, you become a part owner, and when that company makes a profit, they can either reinvest those earnings into the business or share a portion with shareholders. That shared portion is what we call a dividend. Most companies pay dividends on a regular schedule, usually every quarter, but some do it monthly or annually. These payments are typically made in cash, but sometimes they come in the form of additional stock, which can be automatically reinvested into buying more shares, called a dividend reinvestment plan, or DRIP. In simple terms, dividends give you a share of a company's earnings, offering a consistent flow of income for investors. Dividends are essential tools in wealth building, and it's also something that Warren Buffett himself has used over the years. Buffett believes in dividends when a company can't reinvest its profits efficiently. He prefers companies to distribute any extra earnings to shareholders, rather than holding onto it unnecessarily. For instance, if CES Candy were an independent company, it would pay out most of its earnings as dividends, just like it does now, though the money currently goes to Berkshire Hathaway. Some companies in its portfolio pay no dividends at all because they're able to grow their business using their profits. In short, dividends are a smart way for investors to earn a return, whether a company is distributing profits or reinvesting them for growth. Understanding how dividends work is key to building a solid investment strategy. Building a dividend portfolio, Warren Buffett's key principles. How do you create and build a strong dividend portfolio? Creating and building a strong dividend portfolio takes careful planning, and it's all about sticking to time-tested principles, just like Warren Buffett. Let's dive into the key steps you can follow to build a solid dividend-generating portfolio. Number 1. Selecting dividend-paying stocks. The first step is finding companies that consistently pay or even increase their dividends over time. Sectors like consumer staples, utilities, and healthcare are often a good starting point. Look for companies with a strong track record of steady or growing dividend payments. To make smart choices, dive into the company's financial health. Check how they manage their cash flow and their ability to sustain these payouts in the future. Number 2. Long-term perspective. Buffett once said that if you only had 20 investment decisions for your whole life, you'd make each one count. This mindset highlights the importance of thinking long-term. Dividend investing works best when you allow time for compounding or reinvesting the dividends you earn. This can accelerate growth and help you build a much bigger income stream over the years. Number 3. Assessing risk. One of Buffett's key rules is to avoid companies with high debt or those that regularly cut dividends. High debt levels or frequent dividend reductions can be signs of trouble. Instead, Focus on companies with strong balance sheets and those that have proven that they can handle economic downturns without compromising dividend payments. Number 4. Diversification. Buffett often talks about the importance of not putting all your eggs in one basket. Diversification helps protect your portfolio from market ups and downs by spreading your investments across different industries and sectors. While dividends provide regular income, the stock market can be unpredictable. So a diversified portfolio helps reduce the risk if one sector underperforms. Number 5. Monitoring and adjusting. Finally, keep an eye on your portfolio. Things can change, companies evolve, and the economy also fluctuates. So it's important to adjust your portfolio to keep it aligned with your long-term financial goals. Regular reviews will help ensure your investments are still on track. 3 proven strategies for building a strong dividend portfolio. Strategy number 1. Investing in blue-chip dividend stocks. Let's get into the first strategy for securing a steady stream of dividend income. Investing in blue-chip dividend stocks. This approach is like laying a strong foundation for your financial future. Blue-chip stocks represent large, financially stable companies that have been around for years. These companies have proven themselves by consistently paying dividends to their shareholders. They're often giants in industries such as consumer goods, technology, or healthcare, and their financial security makes them dependable, even during rough economic times. The beauty of blue-chip stocks is their reliability. When the economy takes a hit, these companies tend to hold up better than riskier, smaller firms, providing you with a steady flow of dividends, regardless of market conditions. Warren Buffett has always emphasized the importance of temperament over intellect in investing. As he once said, "The most important quality for an investor is temperament, not intellect." You need a temperament that neither derives great pleasure from being with the crowd nor against the crowd. I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances. But you shouldn't buy stocks unless you expect, in my view, to hold them for a very extended period, and you are prepared financially and psychologically. This underscores the value of patience and long-term commitment in investing. Rather than just chasing after the latest market trends, focus on blue-chip stocks, companies with strong market positions, competitive advantages, and a history of paying dividends for decades. By doing so, you're building a stable income stream that will support your financial independence for the long haul. Incorporating blue-chip dividend stocks into your portfolio can provide not only regular income, but also the potential for growth over time. This approach perfectly aligns with Warren Buffett's philosophy of investing in quality companies and holding on to them for the long term. It's a solid, proven method to help you reach your goal of living off dividends and achieving financial freedom. So if you're serious about building a stable, long-term income stream, blue-chip dividend stocks are a great place to start. Strategy 2. Investing in dividend growth stocks. The second key strategy to achieve financial independence through dividends is by investing in dividend growth stocks. These are companies that don't just pay dividends, but consistently increase them over time, offering a unique edge for long-term investors. As Warren Buffett wisely said, the best investment you can make is in yourself. This approach applies here as well as searching out and investing in companies that reinvest in themselves and growing their business while raising dividend payouts regularly. Dividend growth stocks are typically found in industries with strong expansion potential or those that are innovators in their field. These companies reinvest their earnings into development and growth, but still share increasing profits with shareholders through rising dividends. The real power of this strategy comes from compounding. When a company increases its dividends year after year, your earnings grow not only in absolute numbers, but also as a percentage of your original investment. This compounding effect can speed up your financial progress over time, especially if you choose to reinvest those dividends. While the initial dividend yield may not be the highest, the long-term growth potential is what makes these stocks incredibly valuable. The longer you hold on to them, the greater the income you can generate, aligning perfectly with Warren Buffett's focus on long-term investing. By investing in dividend growth stocks, you're not just aiming for immediate income, you're setting yourself up for future financial security. So adding these growth-oriented companies to your portfolio could be a smart step toward reaching your dividend income goals. Strategy number 3, covered call ETFs. Our final strategy for boosting your dividend income involves a unique investment tool called covered call exchange traded funds, or ETFs. These funds offer an intriguing way to maximize your income potential while aligning with Warren Buffett's wisdom. As he once said, the stock market is designed to transfer money from the active to the patient. When it comes to covered call ETFs, patience truly pays off. But what exactly are covered call ETFs, and how do they function? Covered call ETFs blend dividend-paying stocks with options to generate additional income. These funds hold a collection of high-quality stocks and, at the same time, sell call options on those same stocks. Selling these options creates extra income that is distributed to investors as dividends, increasing your monthly payout. Here's how it works. The ETF holds dividend-paying stocks as its core, and then it sells call options on those stocks. A call option gives the buyer the right to purchase a stock at a certain price, known as the strike price, within a specific time frame. By selling these options, the ETF earns premiums, which gets passed on to you, the investor, in the form of higher dividends. However, there's a trade-off. Selling call options means the ETF caps the potential profit from a rising stock price. If a stock in the portfolio experiences a significant increase in value, the ETF might be required to sell it at the strike price, limiting potential gains. That said, covered call ETFs are ideal for investors who prefer consistent income over chasing higher stock price appreciation. By adding covered call ETFs to your portfolio, you can boost your dividend income while managing risk. They are particularly appealing for those looking to enhance their income stream without taking on unnecessary risk. To sum it up, covered call ETFs provide a distinctive way to earn income from your investments. By embracing Buffett's counsel on patience and recognizing the balance between income and potential gains, you can leverage these ETFs as a beneficial resource in your quest for dividend-based living. Think about adding them to your portfolio alongside your other dividend strategies to diversify your income streams and possibly speed up your journey to financial independence. Here are actual covered call ETFs that have a trailing 12-month yield of around 12%. ProShares K1 Free Crude Oil Strategy ETF, or OILK. OILK provides exposure to crude oil through a mix of future contracts and covered call options on those futures. This innovative strategy can yield considerable income for those interested in commodities. Global X S&P 500 Covered Call ETF, or XYLD. XYLD tracks an index of S&P 500 stocks while selling covered call options on them. This approach aims to deliver appealing yield potential for investors while maintaining exposure to large-cap U.S. equities. iShares MSCI Brazil ETF, or EWZ. Although EWZ is not a covered call ETF, it is a conventional ETF that invests in Brazilian stocks. You might consider covered call ETFs focusing on specific international markets like Brazil to enhance diversification in your dividend investment strategy. Conclusion. As we wrap up this journey, keep in mind that successful dividend investing, like any investment strategy, requires your own research and effort. To borrow from Buffett's wisdom, risk comes from not knowing what you're doing. So arm yourself with knowledge, improve your understanding, and temper it all with a good measure of patience. Following Warren Buffett's approach isn't about mirroring his exact movements. It's about embracing the principles behind his choices and applying them to suit your personal investment goals. And who knows? Perhaps in following the path taken by the Oracle of Omaha, you'll find your way to your own investing success. With this, I encourage you to continue learning, investigate deeper, and approach investing with both curiosity and caution. As Buffett himself says, the best investment you can make is an investment in yourself. The more you learn, the more you'll earn. Happy